You may have seen yesterday that the Federal Reserve decided to leave interest rates unchanged. There was really no surprise there. It's exactly what the market expected. But while the headlines may fade away in 48 hours, the real impact of these decisions actually lasts a lot longer. As in most things in life, there are winners and there are losers. So in this video, I'm going to break down who benefits, who gets hurt, and which group has the biggest opportunity based upon where interest rates stand right now. I also want to share something personal. My dad, Fred, his days on earth are numbered, to be frank. And how that ties into interest rates, I'll explain later. Before we dive in, let me quickly introduce myself. Thanks for stopping by the Retirement Guide channel. I'm Daryl Rosen. My firm helps people across the United States plan for and hopefully enjoy a secure retirement. Comments? You know where to put them. Even personal ones, like the guy who told me to shave before making a video. Well, feedback is appreciated. Our first big winner, my wife and her sister, or really anyone selling a house right now. My wife's parents passed away recently. We've got around to finally selling their house. We put it on the market last Friday. 2 days later, it was under contract at 10% over asking price. And the buyer, a rabbi. All the religious ceremonies we skipped, the fact that we took the boys to the children's service after they had facial here, we are redeemed. I'm kidding mostly, but jokes aside, the level of interest was shocking. Why? Because interest rates are so high, fewer people are selling. Homeowners locked into a 3% mortgage aren't eager to trade up to 6%, and that's created a tight market, making homes in desirable areas even more competitive. So if you're selling and don't need to take on a new mortgage, you're in a strong position. But for every winner, there's a loser. And in this case, that includes my son and his wife, who are hoping one day soon, hopefully, to buy a house somewhere out here. After seeing how much buyers were willing to pay for grandma and grandpa's house, I think Josh had a moment of sticker shock. The reality is high interest rates and low inventory means buyers are facing steep competition and higher prices. It's a tough time to enter the market. And if these conditions persist, affordability will remain a serious challenge. Now, there's another group that's really feeling the pain of higher interest rates. People carrying a lot of credit card debt. I recently came across a study from Goldman Sachs Asset Management called Planning the Missing Link to Retirement Security. In it, Goldman describes something they call the financial vortex, which is a combination of financial pressures that chip away at a person's ability to retire. While some factors like inflation have improved over the past year, one thing that has really gotten worse is credit card debt. In their survey, respondents were asked what aspect of your personal finances has changed the most compared to the last year. A staggering 29% said they now have more credit card debt. And here's the problem. If you're only making minimum payments, high interest rates will eat away at your financial future, making it even harder to retire comfortably. Now, I know what you're thinking, Daryl. This is all interesting, but where's the opportunity in all this? You are the retirement guy, aren't you? Nobody calls me that. I hinted at the beginning that there is a silver lining, especially for retirement savers. In just a moment, I'll break down 3 key reasons why people nearing already in retirement are actually in a stronger position right now. Oh, and before we dive in, quick reminder. Our flat fee securement review helps answer 3 critical questions: how to save money on taxes, how to spend more when you're younger and healthier, and how to allocate your investments to increase returns and reduce risk. If this sounds at all helpful, check out the retirementguide.com. So who are the biggest winners in today's interest rate environment? People approaching or already in retirement. Here's why. I want you to picture this. You're sitting with a financial advisor, or you're browsing some kind of retirement website. Maybe you're even on Fidelity or Schwab, and you're using some of their tools. No matter which of these resources you use, they all have one thing in common. They assume a steady rate of growth in your investments, a linear rate of return. So you could use the overly optimistic 12% number Dave Ramsey likes to throw around, which, let's be honest, is not realistic. Or you could be more conservative and assume 5%. Either way, if you have $500,000 today and you're planning to retire in 3 years, those tools will assume your money will grow at a 5% per year rate compounded. It sounds great in theory, right? But we all know the market doesn't work that way. Some years are strong and some, well, not so much. And after a streak of good years, a downturn could hit, and instead of having 5% more, you have 5% less, which completely changes the math. That's why it makes sense to lock in a portion of your money, especially the amount you'll need in the first key years of retirement. Right now, interest rates are still high and money market accounts are paying at least 4%. Not all of your money, of course, because you still need long-term growth to outpace the rate of inflation. That happens in equities, stocks. but some of it, because when risk-free rates are this attractive, not taking advantage of them for your short-term retirement needs is frankly a giant mistake. I'll say this as clearly as possible. If you're retiring in the next few years and you're not securing at least a portion of your money at today's risk-free rates, you're not thinking clearly. Let me show you what I mean. I mentioned earlier that most retirement planning softwares assume a linear rate of growth. I'm in a program right now called Income Conductor, and what I love about this program is it breaks retirement into different segments, so we're really planning based on time horizon. Let me show you down here. I put in here an investment value of $500,000. It's asking me now for a rate of return assumption. I just put 5% in. And what it's suggesting now is that when retirement starts in 6.59 years right here, that the $500,000 is going to be $689,000. Now, that's wonderful if it's greater than 689,000 or even close to 689,000, but it's not great if the market is down 5% or your investments are down 5% this year and you can't get back to this number. It changes the whole plan. That's why, to the extent that you can take care of the first several years of retirement with guaranteed money in some sort, you're ahead of the game. So you can see right here that the retirement date is 2031. If we can lock in money here for the first 5 years of retirement, what we've essentially done is taken a lot of risk off the table. All right, there are two more areas heavily impacted by higher interest rates, and I'm going to cover one right now. Be sure to stick around for the next one because I think that it's a very important topic. It's something I'm going through right now. So let's talk about annuities for a moment. While they're only a small part of my business, I get asked questions all the time about annuities. Are they a good investment? My answer, well, there are really only three situations where I'd recommend one, and frankly, there's a lot of junk out there. But before I can answer whether an annuity is a good investment idea, a good financial move, I have to ask, how long do you think you'll live? And I'm not being flippant here, but annuities function a lot like pensions. They provide guaranteed income for life, or in the case of an annuity, for the life of you and your spouse. I also ask people, are you good at investing? Can you handle market swings, or when things get volatile, will you stay the course and not panic? And more importantly, will you still be able to handle all this decades from now? If the answer is no, or you're uncertain, an annuity might make sense. But here's something I do know for sure. When you hand an insurance company, let's say $100,000, and they promise you a lifetime income stream, what they do is they invest that money very carefully to manage their own risk. Highly rated insurance companies, which are the only ones you should look at, especially in a heavily regulated industry, put most of their money into risk-free or ultra-low assets with layers of safeguards to protect against losses. And here's why this matters now. When interest rates are high, everybody wins. The insurance company earns more, and your payout is significantly better than when rates are low. The pros and cons of annuities don't change, but the math does. Okay, before I wrap up this video, I want to share something very personal because this last area is positively impacted by higher interest rates, and it hits very close to home for me. So I'm recording this video on Thursday, January 30th. My dad is 88 years old. He's battled dementia for years. He's at the very edge now, and I think by the time you watch this video, he may have already passed away. For the last 18 months, he's been in a memory care facility, a decently expensive one, costing nearly $11,000 a month. He had the assets to cover it, but his long-term care insurance has been life-changing for our family. It's not just financial, it's emotional. Every month, Genworth sends a check to the facility, and because of that, he receives the best possible care without the financial stress weighing on all of us. I know a lot of people choose to self-insure, believing it's the better route, and that's fine. But I want you to consider something. Just like with annuities, insurance companies invest in low-risk assets, and when interest rates are high, the guarantees they offer become far more cost-effective. Long-term care policies today can cover massive risks at significantly lower costs than in a low-rate environment. But there's another key point. I always emphasize this. When you insure the back end of your retirement plan, you give yourself permission to enjoy the front end. Knowing you have long-term care coverage means you can spend more freely earlier in retirement while you're still younger and healthier and able to enjoy your money. It's a real game changer. So with all that said, I'm going to wrap up this video. I'm going to go sit with my dad. If you found this video helpful, you might also enjoy this one, and thanks for watching.